You are listening to KeyStone Stock Talk Podcast, episode 99.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
This week, we briefly answer a question in our Your Stock Our Take segment, but in the light of the significant global market drop, we will focus on some issues surrounding the markets generally right now. COVID-19, the drop in oil prices for Canadian energy producers generally, fear in the markets, and how to deal with this fear in your simple 15 to 25 stock portfolio. So in our Your Stock Our Take segment, our question from a listener is on VitalHub Corp, symbol VHI on the TSX Venture, which develops mobile healthcare solutions and allows clinicians to access information about patients. Its technologies include blockchain, patient flow, mobile, and web-based assessment and electronic healthcare record solutions. A client who loves this space asks us if VitalHub, which recently consolidated its shares, is good value at present. So let's get into the show right now. This week we have Brennan with us. He'll be handling the Your Stock Our Take segment, and I also have Aaron here. How are you guys doing? Volatile times?
Yeah, it's been a crazy week, but aside from that, I'm doing good. I'm looking for opportunities right now, and I think that certainly while valuations aren't cheap in the market yet, there's certainly some value has come back. I mean, there's companies that I've really liked that were just too far out of reach because they were too expensive relative to earnings. And now, you're starting to see them come back into a reasonable range. Certainly not blood on the street, certainly not a cheap market, but things are looking more interesting. So, of course, the question is, when do you make a move? And that is the $1 million question that we've been getting a lot from our clients.
For sure. We'll get into that just in a sec. We'd like to remind all of and that's what really we're going to talk about today. I'd like to remind all of our listeners, all of our clients out there, potential clients, that we are heading out on the road soon. Spring 2020, our stock investment seminars are going to be in a city near you. Kelowna, March 31st. Calgary, April 1st. April 2nd will be in Edmonton. Vancouver on April 7th. Langley on April 8th. Victoria, April 9th. Markham, April 14th. Oakville, April 15th. And Montreal, our first time there, on April 16th. Look forward to seeing crowds there. We'll definitely have our hand sanitizers out at those events. Great to see clients and new potential clients in person at these events over the next month and a half. We really look forward to that. Now is actually the time when you really should be coming out to events like this and finding out how to build that simple portfolio. We'll get some hot topics in that event. We'll simply explain to you, detail how to put together that simple 15 to 25 stock portfolio and what you should do in a time like this that we see in the market and the consistent volatility that we're seeing right now. Now, when we talk about fear in the markets, I would say fear causes irrationality, and we expect to see significant irrationality. We already have over the next several weeks and several months. We have been already asked many times from investors if you need to buy right now. Now, initially, most investors think that say 5 to 10 to and even a 20% drop might have everything in the markets essentially cheap. Now, I'll put this in the drop that we're seeing right now in context to clients, and I've put it already in context to many clients who we talked to on the phone. Most of our clients who have attended any one of our weekly chat sessions, we do that twice a week, or seen us in person at one of our 2 to 3 seminars that we have each week across the country, or you've seen us at our speaking engagements, or listened to this podcast on a weekly basis, you will know that we have seen the markets as relatively expensive over the past 12 to 18 months. So let's start there. In terms of buying the market today, this is how I put it to a number of clients. When you have an asset or an item you want to purchase, let's just say it's a nice suit or a dress that you really want to buy, you initially find this item and you see it as expensive. Now you want that item, but it's too pricey for you right now. You're waiting for it to come on sale. Now, if that quote unquote expensive suit or dress is part of a 10% sale, it is likely piques your interest. It does not pique your interest at that point. Now, in fact, many would still view it as relatively expensive. For most people to be interested, you would have to see a 20 to 25% plus drop. Now, that may sound shocking in context of the stock market, but let's look at this is where we were. Now, if the markets, right now where we are in the markets are down from their highs. How far are we on sale now? The Dow is off 18.5%. The NASDAQ is down 17.7%. And the TSX, which underperformed these markets last year, is down around 19.4% and more on a currency adjusted basis in terms of US dollars. But so are we running around like kids in a discount candy store like 2008, 2009? I would say no. The markets, which were expensive a month ago, are still not generally cheap, but we're starting to see some select value, and that's what Aaron was really talking about right now. We are starting to see that, and there are things you can do in your portfolio. If you think something is value, and we're going to make these recommendations to our clients, you can always layer into positions right now. Take a 25% position, take a 50% position in a company that you believe offers value right now. As the markets settle down, as they always do over the long term, you can always add to those positions. Trying to time an exact bottom in the market is a fool's game. And this is one of the reasons we recommend to clients all the time to build that 15 to 25 stock portfolio over an 18-month to 24-month period. Now, it is key to do it in that manner. Now, I know many clients start off and they want to buy 10 to 15 stocks right away. We always advise against that that scenario. And this scenario that's playing out in the markets right now is a prime example of why we advise against that. You don't know when the next crash or correction is starting. So if somebody started with us 6 months ago as a client and they've bought in, say, 3 to 8 of the stocks, the 15 to 25 stocks in their portfolio over that time, they are going to buy still about 60 to 70% of their portfolio, the remainder of their portfolio, on sale on a relative basis at this point. So that's why we do not suggest you go in and buy those 15 to 25 stocks at one point in time. You just juxtapose that with a traditional financial advisor. They're going to buy you those 5 to 10 mutual funds within that first week that you go into the office. If you did that 6 months ago, you would have crystallized your entry point in the market. We believe that's not a good way to do it. This way, you have some powder dry and you're able to add to positions as they become attractive. And we will find some very attractive buys over the next 6 months to 18 months in the market. And that's the way, and that's why we suggest you don't buy and crystallize your entry point at one point in a general market cycle.
It's also about focusing. It's about focusing on the individual companies and really being aware of what you have in your portfolio. So really, nobody has a crystal ball. Nobody can tell you what the market's going to do tomorrow or what the market is going to do in 6 weeks. But the best advice that we can give our clients in a market like this is just don't panic. Don't panic. Be proactive. Don't be reactive. Reactive investors end up losing money. They're always chasing the market. They're always selling at the wrong time, and then they're buying at the wrong time. Buying once the market has already come up, selling once the market has already gone down. It really comes down to the portfolio. The performance of your portfolio is really based on the stocks that you hold in your portfolio. I mean, that might seem obvious, but you really have to understand the companies that you're investing in, and ensuring that you're investing in companies that have a future over the next 5+ years going forward. So just as an example, we've recommended in our US research companies in the cloud computing space, companies in the cyber security space, companies in the artificial intelligence, machine learning, automation space. These technology innovations aren't going away. These are companies that are profitable. They've demonstrated profitability. They have fantastic track records of growth. They have very strong balance sheets. That's another thing. Net cash businesses, which are companies that we like to invest in. Companies that have more cash than debt, or no debt at all and a lot of cash, are much better positioned to deal with a downturn in the markets like this, especially if it's sustained. They can actually take that cash and deploy it into acquisitions, buying assets that are on sale. But really, it comes down to companies that are going to continue to progress with their growth strategy over a 5+ year time horizon. And certainly something like Corona could push the global economy into a recession. That is absolutely a possibility. I'm not saying that it's going to happen, but I can't say that it's not going to happen. We already saw slowing global growth before Corona became an issue. So something like this can really shock global demand, really shock supply chains, and cause people to not invest, not individuals, but companies to not invest and grow their businesses. That may cause a recession. So in some cases, companies that you invest in, they may not grow for 6 months, a couple of quarters, or even a couple of years. But when you're buying a business, you're not looking at what it's going to do over the next 6 weeks. You should be looking at what it's going to be doing over the next 5+ years. And as long as you bought that company at a reasonable valuation, and it's a good, solid business that is continuing to grow, you should get a return over the next 5+ years, 3 to 5+ years, regardless of what happens to the global economy in the near term. So it's really about investing in quality, not buying businesses that are over leveraged with debt. Warren Buffett had a saying. He said that everybody floats when the tide is in, but it's when the tide goes out that you see who's been swimming naked. And what that means is that when the economy is great, it's really easy to lever up with debt and generate a lot of growth, earnings growth, because you're just indebting yourself further. You can get away with that when the economy is really strong. When the economy declines, that's when these businesses get in trouble. This is the reason why even when the economy is really hot, we don't invest in companies that are overly leveraged. We're always looking at our investments based on that 5-year business cycle, where even if we invest in a company and the market goes into recession, the majority of the companies that we invest in will come out the other side of that recession even stronger and will resume their pathways of growth. And this is what investing is. This is what the stock market is about. It's about stomaching the volatility and focusing on quality. And the reality is that price movements like this are actually where investors can make a lot of money long term, where they can invest in companies that are great businesses, but they can buy those companies at a better valuation.
Yeah, I think that's great. Just knowing what you own in your portfolio and knowing if that business, you can keep a level of confidence if you know that business will be around 2 to 5 years from now. I'll give you an example. We talk about this company all the time, the Boyd Group. What do? They fix cars, automobiles. Do we believe that 6 months from now, nobody's going to need to fix their car 2 years from now? No, they're going to still use auto body repair shops. That's why we believe Boyd will continue to be around and will prosper long term. Does this not mean there will be no volatility in the share price near term? No, we expect volatility, but are we confident that that business that we bought 12 years ago will be around 6 to 12 to 2 years from now, 6 to 12 months to 2 years from now? Yes. And that's why we sleep soundly at night owning a company like that, a company like Microsoft. We still sleep soundly at night knowing that, countless millions and millions of people across the world will continue to use their word processing, their cloud computing solutions, and they offer it on a SaaS model. We love that model. We continue to believe that 2 years from now, 5 years from now, people will continue to use that business. So we sleep soundly at night having those type of businesses in our portfolio. And Aaron talked about these cash-rich companies, particularly in the small cap or smaller area. It is great to have a business that has a great net cash position, because in times like these, this is where they really make your returns for the next 2 to 4 years going forward, 2 to 5 years going forward, because they are able to, if there is a continued downturn, there's panic, businesses that would have been expensive for them to buy 6 months ago, a year ago, they come to a level where it is a good value for them to buy. There can be some panic in some of the potential sellers. They can pick up some great businesses on the discount, and then 2 to 5 years from now, they've integrated those businesses into their operations. And when there is a general uptick again in the markets, and you see, coming out of a recession, we're not even saying we're going into a recession, but if that is what happens, these businesses thrive coming out of those and drive tremendous returns over the long term. These are the companies that we have already been positioning ourselves in for years now. We'll look at more of them over the next year, but these are the ones you want in your portfolio. And you can make your money in the downturn by buying these companies, and they will accelerate and produce the returns that you need in your portfolio to grow it over the long term, coming out of any type of downturn in the market. So that is the way we position a 15 to 25 stock portfolio, with good companies that can weather a storm. There can be pain near term. No one is saying there won't be pain near term, but trying to time an exact bottom in the market is a fool's game. What you can control is what you hold, the individual companies that you hold in your portfolio. That is what we are focused on. Many of the companies that we own pay dividends. We will sit and wait, clip those dividends, those sustainable dividends that they have, and buy more companies in a downturn if we see companies come on sale. Now, dividends, let's switch that and segue into what we've seen in the Canadian energy segment. Generally speaking, the price war that has gone on, that we're seeing right now, tremendous drop in the price of oil. Now, our clients will know that for years, for the past decade, KeyStone has minimal exposure to commodity-based businesses as long-term investment decisions. We've made a conscious choice a long time ago that we find that most businesses that are tied to underlying commodities make them highly volatile and make them poor long-term investments. Now, traders are free to trade these things, but we are long-term investors, and generally they have limited interest for us. In fact, our Canadian growth stock research and our U.S. research, we've recommended just one producer and subsequently sold that company, and one direct service company in those research services over the last 10 to 12 years combined. Now, let's focus on dividends here. Many of these Canadian energy producers and many Canadians have bought these producers because they pay dividends and they look like quote-unquote attractive yields for decades or more. We've seen this. We see any business tied to a commodity such as oil and gas to be generally a terrible investment vehicle for a sustainable dividend. In fact, we have constantly stated that dividends in energy companies should be viewed as bonuses. So unfortunately, investors who had purchased this segment and purchased energy-related companies for their yield or for growth in these businesses over the long term have truly taken a hit over the past 5 years. And on this Monday of this week, we saw just complete destruction of capital in that segment. Now, I have heard this past week from analysts and from companies that the drop in energy prices was completely unforeseen, and you've seen these companies cut their dividends and cut growth outlooks going forward. It kind of angers me to the extent that they could say that they could not see that their entire business, which is based off of an underlying commodity, if that commodity goes down and has a significant drop, that would squeeze cash flow and you wouldn't be able to pay a dividend. That is ridiculous to say that you couldn't have foreseen a circumstance in which this would happen. That is why you look at a levered, capital-intensive business paying a dividend. We do not see that as a good model going forward, and we're not surprised to see firms cutting their dividends, ceasing their dividends, and really producing poor returns over the long term for clients in this segment. We're happy to have largely avoided that sector. We're saddened that it will produce negative activity in Canada, particularly in Western Canada, but for all of Canada, seeing the low prices that we see right now. But we're happy to see that we have not participated in that segment for almost a decade now, and we'll continue to find more sustainable businesses that have, if you want a dividend yield, that are not beholden to an underlying commodity for that yield. So I think we're going to that's our final thoughts today on that. We'll talk more about this next week and in the coming weeks, but we're going to move right now to our final Your Stock, or just our first Your Stock, our take of the week.
It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
This question comes in from Christian. He says, I love this space that this company operates in. Can you take a look at it for me? It's VitalHub Corp, symbol VHI on the TSX Venture. You want to take that, Brennan?
I sure do. Okay, so VitalHub Corp currently trading at a price of $1.55 and has a market cap of around 27.6 million. So VitalHub Corp develops mobile healthcare solutions that allow clinicians to access information about patients. Its technologies include blockchain, patient flow, mobile and web-based assessment, and electronic healthcare record solutions. So the share price has been quite volatile over the past 3 years, but it has been on a slow but steady upward trajectory. The company has been growing primarily through acquisitions, with its most recent purchase on November 22nd, 2019, where it purchased Oculus Health, which provides a real-time and predictive operational management system for hospitals. Looking back at VitalHub's acquisition history, since October 5th, 2017, the company has made 4 acquisitions, each of which consisted of VitalHub paying with half cash and half stock. And over this period, the company's outstanding shares have ballooned from 66 million to 188 million. So shareholders have been quite diluted over the years. And at the expense of current shareholders, in January of 2020, the company conducted a 1-for-10 share consolidation, bringing its total issued and outstanding shares from 180 million to 18 million. And just a month after this share consolidation, the company continued on its path of diluting shareholders with another equity offering of 7.5 million shares in February. So taking a look at the company's financial results here for Q3 of 2019, revenue was up 13% to 2.4 million compared to the same quarter last year. EBITDA was up 83% to 285,000 compared to 156,000 for the same quarter last year. And net loss for the quarter was 475,000 compared to a loss of 293,000 for the same quarter last year. So no improvements there. And looking at VitalHub's current valuation, it has an enterprise value to EBITDA multiple of around 21 times, which in my opinion is quite expensive, especially the stock has, came off quite a bit just due to the overall market correction. So this would have been a lot more expensive, in the previous weeks here. And looking at the company's balance sheet, they have a net cash position of 2.3 million and a debt to equity ratio of 0.14, which is relatively healthy. So now our take here. Over the past 3 years, VitalHub's revenue and EBITDA have certainly been on an upward trajectory, but the company has been struggling to work towards consistent profitability. So with this being the case, VitalHub doesn't meet KeyStone's investment criteria as it isn't profitable. Now, my second concern towards an investment in VitalHub is management's lack of discipline in preserving the company's cap table over the years, as we have seen the company make very generous share payments to acquisition targets, numerous public equity offerings, and a recent share consolidation where the company might just be positioning itself to start the dilution cycle all over again. And to top it off, as of the last quarter, the company had an accumulated deficit of $5.8 million. So clearly the company's actions have only destroyed capital along the way. I agree with Christian, who stated that they love the space the company operates in, as there has certainly been a shift in the healthcare sector for web-based health records and overall operational efficiencies through technological innovation. But due to the company's lack of profitability and management's lack of discipline in preserving the company's capital, we would pass on VitalHub.
It's interesting because we took a look at VitalHub when we were doing an analysis on blockchain companies, and because it does have a blockchain component. And I do really like the idea of making healthcare more efficient and adding technology. What I don't know, and what you would really need to do investigation on if you were considering VitalHub as an investment, is what other types of alternatives are there out there, competitive products, and also who's using their products. Do they have just a couple of customers? Is their customer base wide ranged? What's the churn rate? So these are the questions you would ask yourself, but I personally would not need to go that far because the lack of profitability and the relatively high enterprise value to EBITDA multiple would dissuade me from investing. And one thing that I'll also mention, and this doesn't necessarily just apply to VitalHub, but it's any company that's not profitable. These companies can often get away with losing money and just going back to the market to raise more when the market is good and strong. But when we get into conditions like we are in this week, if that persists, these companies may lose their ability to raise capital by issuing more shares. And that puts them in a very dangerous situation because they're continuing to spend money, but they're not making any money. They're not bringing any money in. At least in the case of VitalHub, it does have EBITDA, it does have revenue, but there are thousands of companies out there that don't even have revenue. And if they're not able to go back to the market and raise money, they literally have to cut back everything in order to just survive.
Yeah, and these are the conditions that we're talking about that potentially can occur, that cash-rich companies, you have significant opportunities because there may be some good underlying businesses here, whether it's the entire business or some of the businesses that they have acquired. If you get into a cash crunch situation, the cash-rich businesses that we like to buy can be salivating over that, and they can pick up those businesses on the cheap. In this case of VitalHub, they have not been good stewards of investing capital in the past and diluted investors to huge losses. You're looking at relatively high multiples. Like Brennan said, we like some of the underlying business here, web-based healthcare. Making that segment more efficient is a great business. Whether or not this is the company to do that or help in that segment, there's only 13% revenue growth in the last quarter. You'd expect to see higher growth levels for a company that is trading at a trailing EV to EBITDA of around 21. So not good stewards of capital in the past. That's all we can go on. Interesting business, but the high multiples would have us not investing in VitalHub at present. It may be a company that we continue to monitor. For sure, we do continue to monitor that business. It would have to become a lot cheaper, and we'd likely have to see better growth for this company to be very attractive for us. So are there any final comments, Aaron or Brennan, on the markets generally right now? Nothing, guys?
Stay rational?
Yeah.
No, I think just having that long-term approach. I know you guys talked about it previously, and Aaron touched on it, but just Warren Buffett's his letter to his shareholders of Berkshire Hathaway, just keeping that mindset. Long-term, you're going to do well in the market if you just keep that long-term outlook, and don't make any I guess emotional decisions,
Yeah, for sure. And there's fear out there, and we do definitely see that, and we understand that fear. Just knowing the individual businesses that you have bought, that you purchased in your portfolio, make sure that they have good balance sheets right now. And, many of the companies, even in the small cap related businesses that we have recommended, are paying 2 to 4.5%, 5% dividends right now. Clipping those dividends in good businesses is a great way to, insulate your portfolio during a downturn. And then those businesses with great balance sheets can make purchases on the cheap in a downturn and accelerate your returns coming out of that downturn. And we've said this in high times in the past. You really make your money in a downturn. This is when we continue to scour the market. We always are scouring the market for good value. But if we see, 20, 30% plus drops in the market and in some individual companies that we really want to own, and they become on sale, that excites us. That is how we can make outstretched returns over the long term, by buying these companies at reasonable prices and holding them over the long term. And we'll continue to do that. And we'll continue to see all of our, many of our clients and many potential clients at the upcoming seminars that we'll be holding across the country in the next month and a half. I look forward to seeing many of you at those seminars. Keep your questions coming in. We're getting many right now for our Your Stock, Our Take segment. You can also ask us anything on the markets generally. We'll continue to answer those questions. As always, I wish you profitable investing. Thank you.
Thanks, everyone.